the US dollar has seen a strong surge in the past week. The rally was triggered by the outcome of the US Federal Reserve meeting on Wednesday. The Fed reiterated that the stimulus in the form of asset purchases will end by March. On the interest rate front, the central bank had said that it will be appropriate to increase the rate soon as inflation is staying well above 2% and the labor market is also strong. In addition to this, the Fed had also said that the process of reducing its balance sheet will begin after starting to increase the interest rate. The US dollar index got a boost after the Fed meeting and broke above the crucial level of 97. That, in turn, dragged the euro down to below the key support level of 1.12. On the domestic front, the strength in the US dollar dragged the Indian rupee sharply below 75 during the week. On the data release front, the Institute of Supply Management's Purchasing Managers Index data on Tuesday and the non-farm payroll and unemployment numbers on Friday are key to watch this week. For the euro, the European Central Bank meeting outcome is due on Thursday. It will be interesting to see if the ECB will also turn hawkish following the Fed meeting outcome last week. The much-awaited break above 97 on the dollar index has happened. This keeps the broader, bullish outlook intact. Immediate support will be at 96.85. While the index sustains above this support, a rise to 98 is possible in the near term. The level of 98 is a strong resistance and can hold on its first test. A pullback from 98 can drag the index down to 97 or even 96.50 in the coming week. However, the broader outlook will continue to remain bullish. As long as the index stays above 96, the chances are high for it to break 98 and see a rise to 100 to 101 in the coming month. The prolonged sideways consolidation in the euro has come to an end. The currency has broken its 1.12 to 1.14 range on the downside as expected. This keeps our broader, bearish view intact. Any bounce above 1.12 from here will be short-lived as fresh sellers are likely to emerge in the 1.1250 to 1.1300 region and cap the upside. As such, the view is bearish for the euro to fall to 1.1050 to 1.10 in the coming week. From a medium-term perspective, the current fall in the euro can extend up to 1.08 before bottoming out. The US 10-year Treasury yield surged to a high of 1.88% after the outcome of the Fed meeting and had come off from there to close the week at 1.77%. The overall outlook is bullish. However, the yields can consolidate in the 1.7 to 1.9% range for some time before witnessing a fresh rise. From a bigger picture, 1.65% is a strong support. As long as the 10-year Treasury yields remain above 1.65%, the outlook is bullish to see 2% and even higher levels in the coming month. The Indian rupee fell sharply below 75 after the US Federal Reserve meeting outcome. It made a low of 75.30 on Thursday and had managed to recover slightly from there to close the week at 75.04. The sharp fall below 74.75 last week has confirmed an inverted head and shoulder pattern on the chart. This is a bearish pattern and strengthens the case to see further fall in the rupee. Resistance will now be in the 74.80 to 74.70 region. The neckline support of the inverted head and shoulder pattern is also coming around 74.70. As such, it will be difficult for the rupee to strengthen beyond 74.70 immediately. Support is at 75.50 to 75.60, and it can be tested in the near term while the rupee trades below 74.70. A strong break below 75.60 will then pave way for a fresh fall to 76 and even 76.50 in the coming week.